I think the AI related spending and essentially what is priced in? What is priced in to the market related to AI? I think is one of the most important questions that an equity investor should be thinking through as they're buying the market. Not just the AI names, which I talked about, but how is AI expected to influence the totality of the market? Now, this is a case where I think it's important from a analysis perspective that instead of having a strong view in one direction or another, it's important to start with an understanding of what's priced in and then think about the plausibility of that dynamic happening. And so, what I've done with this work here is I basically said, look, take as a given the expectations that are being talked about related to AI when it comes to the next, say, 8 years from the techno optimists. Just take it as for granted that this is what is actually going to transpire. How much would that path forward support equities relative to say where they were priced? I don't know, post SVB, right? I think is a good benchmark because that's really where the AI story started to get meaningfully influencing the equity markets. And so on the left-hand side, what you see, this is from Bloomberg, is basically a view of what the expected investment related to AI will be over time until it starts to sort of level out as a share of total tech-related infrastructure. And so you see moving from the last year, which was, if you can see it, was basically $65 billion with expectations that by 2032, it would rise to $1.4 trillion. So that investment, let's just assume that that is entirely earned, that those sales related to that investment is entirely earned by S&P 500 companies. Let's also assume that there is a massive boom in labor productivity related to AI. And here in the middle chart, what we show is JP Morgan has penciled out what the possible path of AI, of improvement in productivity could be from AI. Basically penciling out something that is about twice as fast as the impact of the personal computer and about 50% larger. So let's call that 2% in terms of productivity benefit on an annualized basis. Well, what does that get you? If you put that together, what does that get you in terms of increased revenue growth, right? Revenue growth from the investment and revenue growth from the increased productivity. And what you see here is basically what you get is, let's say the baseline US nominal GDP growth is about 4% nominal. You add in that AI spend of 1.5 trillion by 2032, you get, you add about 70 basis points of revenue growth. And then you add in that 2% productivity growth, and you get something that's in the ballpark of just over 5%, or just over 6%, I'm sorry, total earnings growth in the future. So, what does that mean? Well, that is, transitioning from, let's say, something like 4% earnings growth to something like 6 to 6.5% earnings growth. That certainly would be beneficial to stocks, but you're not talking about something over the course of the next 8 years that would be a huge influence on stocks. That's something, on the order of hundreds of billions of dollars, hundreds of billions of dollars in incremental earnings by 2032. So what would you pay for if you knew that there were hundreds of billions of dollars of incremental earnings, let's say $500 billion of incremental earnings that would come by 2032, what would you pay for that? Even if you paid 20 times today, you're not talking about relative to a US market cap that's something like $50 trillion. You're really not talking about a huge influence on stock prices. It's certainly a benefit, but not a huge influence. So this on the surface, this is not enough to get you to the point where you're talking about stocks, nearly doubling as a function of the AI story. So how do you get to stocks nearly doubling of an AI story? It has to come through margins. And I think that's the important thing to recognize is many techno-optimists will talk about how the AI revolution will create earnings growth that will persist in the double digits to the mid double digits. The most extreme techno optimists will talk in those terms. If you pencil that out, in order to get even low double digit returns, growth rates in terms of earnings, what you'd have to do is get something like a 1% margin increase each year. I want to emphasize each year you'd have to get a 1% margin increase. And so what would that mean? Well, if you take a look at what that would look like historically, what it would do, it would be to transfer create a transition where corporate margins move from where they are right now, which is about 12 or 13%, up to 21% over the course of the next 8 years, representing the single greatest boom in corporate margins that has ever existed. That is what is necessary, and by a mile, right? To multiples of where they've been on a long-term basis. Now, could that happen? Certainly could happen. One of the challenges with margin expansion, and particularly margin expansion when it leads to a reduction in costs, particularly labor costs, is who is going to pay for the goods and services that are resultant, right? So many companies will talk about, hey, look, I was able to fire 90% of my workforce in a particular area in order, leveraging AI. That's a sort of a typical corporate story. The thing that doesn't get, and then that sort of gets extrapolated. Well, hey, look, we can just, essentially gain all of that in terms of reduced headcount and maintain our top line revenue. But one of the most important things that anyone who lived through the tech boom learned was that one person's income is their spending. And if you lay off a bunch of people, you're not going to get spending to continue at the same rate unless someone else saves. And so that's the basic question, is if you're going to get the sort of earnings growth that is essentially priced in, and this priced in earnings growth, would be enough to basically double the S&P 500 from where we were in the post SVB period if you put 20 times earnings on it. In order to get this kind of earnings growth and this kind of sales growth, some sector of the economy has to then change their savings rate to save in exact offset of the margin increase that you see in the corporate sector.